China, China. We have not been paying enough attention to the other side of the Pacific in our conversations here in the cryptocurrency markets. And yes, obviously, the USA is still the 500-pound economic silverback gorilla that pummels everything with his big fat fists. But there is a dragon that is about to unleash $140 billion of stimulus that could, of course, send shockwaves right around the world and pump up our Bitcoin bags. Most importantly, China is releasing 1 trillion yuan, worth about 140 billion bucks, in long-term special treasury bonds to raise funds, of course, that's going to use to stimulate key economic sectors of its struggling economy right now. How will this affect the market? And more importantly, more specifically, more interestingly for crypto investors, our bags? Well, let's find the answers together. First things first, we need to ask, what exactly are these bonds anyway? Well, in the simplest of terms, it is, of course, a contract issued out by a sovereign government like China that says, hey, I owe you some money. And I promise to pay you back after a specific period of time and with interest, of course, for you taking the risk of buying those bonds in the first place. Now, governments usually do this to plug holes in their budgets, stuff like that. So now we also have to remember that the most popular bond is the one issued out by Uncle Sam, America. That's not surprising because for all of the U.S. economy's faults, U.S. bonds are backed by the full faith and credit of the U.S. government, which most people still believe is pretty gosh darn good. And they have a strong track record, of course, of paying their debts on time, which matters, obviously. Thus, it's considered to be a safe haven for investors, especially in times of economic uncertainty. And now that we know what the bond is, our next question is, why is China doing this? Well, analysts are looking at a couple of different reasons. The first reason is that the local governments in China have actually been borrowing very heavily through local government financing vehicles in order to fund, infrastructure project, bridges and ports and railroad, whatever kind of stuff that, local governments do. Anyway, so these debts, they're maturing in very large amounts right now with a record high of 4.7 trillion yuan expected this year alone. So issuing long-term bonds allows for the central and national governments to raise money and to potentially help mitigate and manage a bit of this local government debt burden. The second is because the economy in China is facing several challenges right now, despite the fact that China is the global factory. There are things happening. We've talked about these: the property downturn, weaker consumer spending, loss of business confidence. I mean, the COVID thing really hit the Chinese economy bad, and it hasn't fully recovered yet. The government needs funds to invest in infrastructure and other areas to keep the economy growing, keep things moving forward. Of course, China's also facing a demographic crisis like many countries. A top-ranking official is also saying that the bonds will be used to support the implementation of major national strategies and to build up security capacity. In short, the Chinese government, they need some money, man. And these bonds, which will mature in 20 to 50 years. It was buying that. Oh my God. Anyway, they're a quick way of getting cash for the government. So why is all this important? Obviously, first, we need to understand that China is the second largest economy in the world, and it controls more than 17% of the global GDP and is a major manufacturing powerhouse for basically everything. So whatever happens in China, yes, will affect the world market. And if we dig deeper, one of the most significant potential impacts of China's bond sales is the injection of liquidity into the global financial system. Remember, China let us out of liquidity slump in late 2022. See, when China issues bonds, it essentially borrows money from investors. This new money is injected into the Chinese financial system. But the story doesn't end there. Investors who are buying these Chinese bonds then use existing cash reserves held in bank accounts or in different investment portfolios and stuff like that. This cash then finds its way to China's central bank, or the People's Bank of China. Now, this newfound cash then becomes fuel for whatever project that they have in mind. The central bank can then use this money to purchase other financial assets like government bonds. I know, right? That's what they do, whether by other countries or, themselves. Anyway, they can also buy gold and stuff like that too. But by doing this, the Chinese central bank is just basically injecting cash into the global financial system, thus increasing the money supply. And all that money gets spent on infrastructure projects and stuff too. Again, more money in the economy globally. The government can also use the money to fund projects. And again, all this money eventually finds its way into the financial system. Money is the oil of the economy. Think of it this way. Any thing that they do, any project's going to have contractors, going to have employees, going to have companies working together. People need to produce the cement and the trucks and all this kind of stuff. So once all those people get paid, the money will either be spent, saved, or invested. Either way, it gets back to the financial system. Now, with the increased money supply, there's more competition among lenders that could drive down interest rates globally. Now, this, of course, all makes borrowing cheaper for businesses and for governments worldwide, thus stimulating economic activity and potentially leading to higher investment and higher consumer spending. Now, here's where it gets very interesting, of course, for the cryptocurrency investors, you probably. We've all been waiting for the Fed Chair Jerome Powell to come out and say, hey, guys, we've had enough of this high interest rate bullshit that we've been doing, and we're ready to bring them down, okay? However, as we saw in the latest readings of the PPI and the CPI, we might have to wait a little bit longer because we're still at 3.4% inflation. They want to get back down to 2. So unless the inflation rate magically goes down to 2% overnight, or the Fed just decides, well, enough's enough, we can't really crush the economy anymore, well, we might have to contend with that higher rates for longer. However, the Chinese, they are complicating things even further by dumping U.S. debt right now. This, of course, creates more pressure for the Americans to lower rates because without China buying their debt right now, and in fact, with China selling U.S. debt, it's a problem. And the U.S. is increasingly thus forced to flood the system with money as well. Everybody's printing, baby. Print it all. Everyone's painted themselves into a corner. The central banks have no other options. It's crazy. The result for risk assets could be spectacular. Also, with China's long-term bonds, it might be possible to see lower borrowing rates actually happening too in China. Remember, lower rates make it easier for borrowers to have money for all kinds of different economic activities, like investing in real estate, which creates wealth effect, which then they go up into Bitcoin. Obviously, direct path. Some of this money, of course, does end up in crypto eventually. More money in the system means more money. Rising tides lift all boats for crypto, right? Let's not forget the Hong Kong Bitcoin ETFs. Not hard to imagine that the additional money supply will also go to Hong Kong, or more likely that the Hong Kong Bitcoin ETFs via Stock Connect get listed for mainland buyers in Shanghai and Shenzhen markets. Now, I've said this a few times, Hong Kong is very important since this is going to allow mainland China to finally have exposure to those crypto ETFs via Stock Connect through the Shanghai and Shenzhen stock markets. And I know that the amount that they can buy will be smaller when compared to what Wall Street can buy. Okay, obviously. But as it is, Bitcoin miners are not producing enough Bitcoin to cater just for the US-based Bitcoin ETFs. Remember, in the last 2 weeks, they bought 6 times as much as miners produced. So whatever amount Hong Kong buys via the mainland or just from Hong Kong itself will contribute to scarcity. And let's not forget about South Korea. Let's not forget about other Asian countries that might enter the mix, like Japan. Will Japan do a Bitcoin ETF? Well, if everyone else is doing it, maybe they will. They're coming for your Bitcoin, guys, especially when you consider the Chinese property markets. They have been in the dumps for a very long time now, which is why Chinese investors have been increasingly turning towards gold like crazy. They've been flocking to gold like nuts in China. Just give those people a Bitcoin ETF, man, and watch the heck out. The view becomes clear. China floods the system with money, but that money doesn't go to property this time. It goes to gold. And when the Bitcoin ETF starts trading in mainland on the Shenzhen and Shanghai markets, it then goes to Bitcoin as well. And that could happen a lot sooner than people expect, according to rumors that we're currently hearing floating around from people in the know in China. Are you seeing the bigger picture yet? Money printing matters. Money printing is the tide that lifts all financial boats, and a tsunami of Asian money is coming. And things will get crazier than we have even possibly imagined. We have not yet seen the mega pumps in this market. I hope you have your bags filled and ready. Thanks for watching. I'll see you in the next one.